Welcome back, traders, to this technical analysis video. My name is Cristina Parthenidu, a market analyst, and at this video I'm going to break down three major FX pairs: euro dollar, Aussie dollar, and dollar yen, as the US president is about to launch his reciprocal tariffs against all trade partners, and investors are wondering whether there will be any sectoral exemptions as growth concerns are heating up, and investors are really concerned about a potential global trade war. But tariffs will not be the only key market moving event this week. Eurozone CPI inflation data will be out on Tuesday, April 1st. In the same day, the Reserve Bank of Australia will announce its policy decision during Asian trading hours, while later in the week, US ISM business PMI figures, as well as the all-important of payrolls report, could provide us with more insight about how the US economy is performing. So it might be a very busy week of data releases, and let's start first with euro dollar and eurozone CPI data. Well, the headline CPI inflation figure is expected to come in steady at 2.3% year on year. The core measure is expected to ease slightly to 2.5% from 2.6% previously, but overall, even if the data surprise to the downside, the euro may not react aggressively, may not respond swiftly, as investors are pretty confident that the ECB will cut interest rates by 25 basis points in April. So the data may not cause strong volatility in euro dollar, but a positive surprise in inflation figures that could probably challenge the decision for another rate cut as soon as next month. So in this case, we may see an extension of this upturn above the 1.0843 level, where the 20-day moving average is located. That line is currently acting as resistance, so if we successfully surpass this, then we may see another test near the 5-month high 1.0953. There's a tentative resistance line which you can create, the one that connects the highs from September and March. This comes at 1.0925, so that level may also attract attention before, and if we successfully surpass it, then the 1.10 level could be the next target. Perhaps the 1.1050 territory could be more important, because this includes this resistance trend line from 2021. Now, beyond that, if we see more higher highs above the 1.1050 level, that could add more credence to this up, or to this up leg over here. And in this case, traders may get excited, likely driving the price quickly towards the double top territory of 1.1175 and 1.12. Well, if we look at the technical indicators, we do have some positive signs. The indicators are within the positive area. We recently had a bullish cross between the 20 and 200-day moving averages, which is also a positive sign. But if the price fails to hold above the 1.0770 number, more importantly, breaks below the 1.0735 and beneath the 200-day moving average, which acted as strong support last week, then that could dampen market sentiment, and it could cause a steeper decline towards the 1.0665 former constraining zone. Slightly lower than that, I think that there might be some consolidation between 1.0625 and 1.6. This is where this tentative support trend line is placed. Now looking at Aussie dollar, well, the Reserve Bank of Australia is not expected to cut interest rates as trade uncertainty remains large, and Australia will also head to the polls on May 5th, so policymakers may wisely stay on the sidelines despite delivering only one rate cut so far. Indeed, politics may affect economic indicators, so probably the central bank would like more evidence to proceed with more rate reductions. At the moment, we can see that the 0.6225 level is currently in target. This is where the support line is placed, and if we break below this, then the 0.6185 low from March could also come to the rescue. below that, I believe that there might be a tougher battle near 0.6140, because this is where the price of gained significant momentum back in January. So if we fail to hold here, that could activate fresh selling towards the 5-year low of 0.6085, or even towards the 0.60 round level where this tentative support line is placed. From a technical perspective, I believe that the bias is skewed to the downside. If we look at the RSI and the stochastics, and even the MACD, are all pointing downwards, so downside risks seem to be more likely than upside ones. However, if we move above the 0.63 number, where the 20 and 50-day moving averages are placed, that could give some extra confidence to reach the 0.6375 resistance zone. The 0.6412 territory includes a couple of trend lines and the 38.2% Fibonacci retracement of these down legs, so I would pay attention to this territory before targeting the next barrier near the 0.65 level and the 200-day moving average. And finally, looking at dollar yen, well, the US non-farm payrolls report is expected to show a slowdown in employment, 240,000 from 150,000 previously. The unemployment rate could stay steady at 4.1%, and average hourly earnings may ease to 3.9% year on year. Well, that may not be a great report, but it may not be a bad one either. So perhaps any surprises will be closely watched, particularly as federal layoffs have yet to show up in the data. So if we get negative surprises in the report, and if the ISM business PMI figures suggest that employers are still are afraid, are concerned about their hiring plans, they are more skeptic about additional hiring, then that could probably increase growth concerns, likely adding more pressure on the US dollar, in which case we may see a break below the 148.55 support zone, where the upper band of this bearish channel is placed. Then below that, the next support could come around the March low of around 146.50, 147, and if that fails to hold, we may see a steeper decline towards the 143.85 zone, where this ascending trend line, which connects the lows from 2023 and 2024, are placed. From a technical perspective, well, the risk is skewed to the downside here as well. We can see that the RSI is easing below 50. The stochastic oscillator has also turned down, so there is a risk for a bearish continuation. However, if the price manages to hold above the 23.6% Fibonacci of 149.45, then I expect another test near the 151.45 zone, a break of which could take us towards the next barriers in between 152.70, 153. The 50% Fibonacci mark is placed here as well, so a successful penetration higher may take us towards the next Fibonacci level of 154.40. But let's see whether the price will manage to achieve a bullish trend reversal, as the death cross between the 50 and 200-day exponential moving averages is currently keeping hopes low about a bullish trend reversal. So that's everything I want to share with you guys. It will be a very interesting week, so keep a close eye on those pairs. If you liked my video, please subscribe to this channel. I will be back next week for more technical analysis. So wish you have a great trading session, and we will be back soon. Bye bye for now.